You just got a raise. Feels good, right? You're finally making decent money. You're thinking about maybe upgrading the car or finally taking that vacation to Europe. You're catching up. But have you noticed that even though you're making more money than you did 5 years ago, you feel poorer? Have you noticed that the things you actually want, a house, a decent used car, even just groceries, seem to get more expensive the moment you get a little extra cash in your pocket? You got a 3% raise this year, but your rent went up 8%. Your grocery bill went up 6%. Your dream home, it went up 12%. You sit there looking at your bank account and you do the math. You're running faster, but you're staying in the exact same place. It feels like you're on a treadmill where someone else controls the speed. And you know what the worst part is? The news tells you inflation is only 2.5%. The government tells you the economy is strong, but your wallet tells you a different story. Your wallet tells you that you're getting screwed. Here's the thing, you're not crazy, and you're not bad at math. You are a victim of the Cantillon effect. And no, that's not a new energy drink. It's the single most important economic concept that explains why the rich get richer, why you feel stuck, and why the game is rigged. But here's what most people don't realize. Understanding the Cantillon effect isn't just about getting angry. It's about changing where you stand. Because if you can't get to the source of the money, you have to position yourself closer to it. And today, I'm going to show you exactly how. My name is James, and I spend way too much time thinking about the hidden mechanics of monetary policy that keep the average person broke. If you're someone who works hard, saves money, and still feels like you're falling behind while the stock market and housing market hit record highs, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Most people think investing is about picking the right stocks or the right crypto. The truth, it's about understanding where the money comes from before it gets to you. I'm building a community at the Frugal Investor * newsletter where we strip away the hype and focus on high-impact, low-cost wealth building. Get your copy, the 15-day blueprint for wealth and financial autonomy, and join a group of like-minded investors who prioritize long-term gains over short-term trends. Link is in the description. Let's start with a story. It's 2020, March. The world is shutting down, the economy is in a coma, the news is terrifying, and the Federal Reserve, along with the Treasury, decides to do something about it. They start creating money. Not physically printing it, but digitally creating it. Trillions of dollars, they pump it into the financial system. Now, where does that money go first? Does it get airdropped equally into every bank account in America? Does a helicopter fly over your house and shower you with cash? No. The new money enters the economy at specific points. It goes to the primary dealers, the big banks. It goes to the Treasury. It goes to the largest financial institutions. It goes to the people who are already connected to the government's money spigot. These institutions get this brand new, fresh money, and they have a problem. They can't just leave it sitting there. They need to deploy it. They need to put it to work before it loses value. So what do? They buy assets, they buy bonds, they buy stocks, they buy real estate. And this is where you come in. You, the regular person, are still working your job. You haven't seen any of this new money yet. You're still getting paid the same salary. But suddenly you look at the stock market. It's going up. You look at house prices. They're going up. You look at the cost of raw materials. They're going up. You haven't received any of the new money, but you are feeling all of its effects. The stuff you want to buy is getting more expensive, but your income hasn't changed. This is the Cantillon effect, named after the 18th century economist Richard Cantillon. He observed that changes in the money supply don't affect all prices equally or simultaneously. The money flows through the economy like water through a series of pipes. The people closest to the source, the faucet, get to drink first. They get to use that money to buy assets before prices go up. By the time the money trickles down to you in the form of higher wages, the assets are already expensive, and all you're left with is higher prices for milk and bread. Let's make this real with some numbers, because this is where the frustration really sets in. Let's say, for the sake of argument, that the Federal Reserve creates $5 trillion between 2020 and 2022. I know that sounds like a made-up number, but it's roughly accurate if you look at the balance sheet expansion. Where does that $5 trillion go? A study by the Federal Reserve itself, the 2021 Survey of Consumer Finances, shows the staggering disparity. During that period, the net worth of the top 1% increased by over $12 trillion. The bottom 50%. Their net worth increased by about $1.5 trillion. Now you might look at that and say, see, everyone gained, but look at the composition. The bottom 50%, their wealth is mostly in the form of bank accounts and maybe a little bit of home equity. The top 1%, their wealth is in stocks, bonds, businesses, and real estate. So when the new money is created, it flows first into the financial system. The big banks and hedge funds get it. They use it to buy stocks. That pushes the stock market higher. The top 1% who already own the majority of stocks see their wealth explode. They feel richer. Now, 6 months later, after the stock market has ripped, some of that money starts to leak into the real economy. Companies that have benefited from the stock market boom might hire more people. They might give raises. So you finally maybe get a 3% raise at the end of the year. You feel good. But you go to buy a house, and you find out that house prices have gone up 20%. Your 3% raise is competing against people who got the money 18 months ago and have already used it to buy 3 rental properties. This is where it gets really interesting. You aren't just competing against your neighbor anymore. You are competing against the Federal Reserve's balance sheet. You are competing against people who have access to capital before you do. Here's a statistic that will blow your mind. According to data from the Census Bureau and the National Association of Realtors, the homeownership rate for Americans under 35 has barely budged in decades, despite low unemployment. Why? Because the entry price keeps moving higher and wages are the last thing to adjust. By the time the money gets to you, the opportunity is gone. You're left holding the bag, paying higher rent to the person who bought the building 3 years ago with cheap money. Now let's talk about the brain. Because the Cantillon effect doesn't just steal your purchasing power, it messes with your head. Think about how this feels. You see the stock market hitting all-time highs. You see your 401k statement and maybe it looks okay, but you don't feel rich. You feel anxious. You feel like you're missing something. This creates a psychological condition I call wealth FOMO. You see other people getting rich, seemingly out of nowhere. You see crypto bros buying Lamborghinis. You see house flippers on TV. And you think, what's wrong with me? Why am I not getting rich? So you do the logical thing. You try to catch up. You buy the stock at the top. You buy the crypto after it's already gone up 10,000%. You try to buy a house in a bidding war you can't afford. Why? Because you're trying to get closer to the source. Your brain recognizes, subconsciously, that the only way to win this game is to get the money before it loses its value. So you chase risk. The problem is, by the time you hear about the opportunity, the people at the source are already selling to you. They are the smart money, and you are the dumb money. I remember talking to a guy in 2021. He was a waiter. He was day trading meme stocks on his phone between shifts. He was making money on paper. And he said to me, "James, this is the only way out. My rent keeps going up. My tips aren't keeping pace. I have to gamble to survive." And he was right. He was articulating the Cantillon effect without knowing it. He felt that the only way to beat the system was to insert himself into the financial casino, because the traditional path of work hard and save was a guaranteed loss. Here's a simple way to visualize this. Imagine you're at a party. There's a giant bowl of punch in the middle of the room. That punch represents the money supply. Now the Federal Reserve isn't at the party. They're in the kitchen with a hose, pumping more concentrate into the bowl through a pipe. But the pipe doesn't empty into the middle of the bowl. It empties into a specific corner of the bowl. Who is standing in that corner? The big banks, the primary dealers, the wealthy insiders. They get the undiluted concentrate. It's pure, strong, and potent. They drink it straight. They get a massive sugar high. Then, as they move around the party, the concentrate mixes with the rest of the punch. It spreads out. By the time the punch reaches you, standing on the other side of the room, it's watered down. You're getting the diluted version. You're getting the leftovers. And here's the kicker. When you finally get to the bowl to get your cup of diluted punch, the people in the corner are already drunk. They're already feeling the effects. And they're now looking at you and they're saying, "Hey, look at this guy. He's so late to the party. He's such a loser." You're not late, you're just far from the kitchen. This isn't new. This has been happening for centuries. Cantillon observed it in the 1700s with the French currency. When the government debased the currency or printed money, the prices of goods near Paris, where the court was, went up first. The nobility got the new money, spent it, and prices rose. By the time the money reached the countryside, the farmers had to pay more for everything, but their incomes hadn't gone up. We saw it during the 2008 financial crisis. The Fed created money to save the banks. That money didn't go to the people losing their homes. It went to the banks. Those banks used that money to buy assets, which set off the longest bull market in history. The rich got richer, and the recovery was K-shaped. One line going up for asset owners, one line going down for wage earners. We saw it again in 2020. The money went to corporations and financial markets. The result, the everything bubble. Stocks, bonds, real estate, crypto, collectibles, everything went up except the value of your labor. Now you might be thinking, "James, this is depressing. You're just explaining why I'm doomed. What's the point?" The point is that understanding the mechanism allows you to change your position. You cannot become a primary dealer. You cannot sit at the table with the Fed. But you can move closer to the kitchen. You can position your portfolio to be one of the first things the new money touches when it enters the economy, rather than one of the last. This is the actionable part. This is how you fight back. Step 1, own the pipes, not the water. The first thing you need to understand is that the new money flows through specific pipes. Those pipes are the financial assets. The water is cash. If you are holding cash in a checking account earning 0.01%, you are the last person in line. By the time you spend that cash, inflation has already eroded its value. You need to own the pipes. You need to own assets that are directly in the path of the new money. What are those assets? Hard assets, ***, real estate, land, commodities. When new money is created, it seeks a store of value. Real estate is a finite resource. It's a classic inflation hedge. Equities, *** stocks of companies with pricing power. Companies that can raise their prices to keep up with inflation. Companies that borrow money cheaply and own hard assets themselves. Treasury Inflation-Protected Securities, TIPS. These are bonds that adjust their principal based on inflation. They are a direct bet on the government's own inflation numbers. If you're worried about the Cantillon effect, TIPS are a way to get the government to pay you for the money they're printing. Productive assets, anything that generates income. A business, a rental property, intellectual property. These assets can reprice themselves over time. Step 2, the leverage game used carefully. This is where it gets counterintuitive and slightly dangerous, so listen carefully. The people at the source, the banks, the institutions, they don't buy things with cash. They buy things with borrowed money. They use leverage. Why? Because when new money is being created, the debt you take out today gets paid back tomorrow with cheaper dollars. If you borrow $300,000 to buy a house today, and over the next 10 years the Fed creates $10 trillion, your $300,000 debt becomes easier to pay back because your income, hopefully, rises with inflation, and the asset, the house, rises with inflation. You are using the system's own mechanism against it. Now, I am not telling you to go out and max out your credit cards or take out a massive margin loan to buy Bitcoin. That's how you get destroyed. Leverage is a double-edged sword. But fixed-rate, long-term debt on a hard asset, that is a classic Cantillon hedge. You are locking in today's cost of money while the central bank works to devalue that money. The bank lends you $300,000 that is worth 100% today. You pay them back over 30 years with dollars that are worth 50% of what they were. You win. They lose. Step 3, the income arbitrage. Here, what most people don't realize. Your most valuable asset in a Cantillon world is your ability to earn income that can be immediately invested. Remember, wages are the last thing to adjust. So if you are a salaried employee, you are getting hit twice. You get the diluted money last, and you pay inflated prices for assets. But if you can create a side income, a freelance gig, a small business, anything that allows you to earn money that you can immediately deploy into assets before you spend it on consumption, you create your own mini source. You become the bank for your own household. You capture the new money from your clients or customers, and you immediately convert it into the pipes, assets, before it loses its purchasing power to the milk and bread inflation. Here's the hard truth that most financial gurus won't tell you. The Cantillon effect isn't a bug, it's a feature. The system is designed this way. The people who create the money are connected to the people who receive the money first. It's a transfer of wealth from the savers to the borrowers, from the latecomers to the early receivers, from the poor to the rich. Understanding this should make you angry, but anger is a fuel. Use it to change your behavior. Stop saving cash under the mattress. Stop waiting for prices to come down. They are not coming down. The goal of the central bank is to create a little bit of inflation always. It makes the debt go away. It makes the economy look like it's growing. You have to accept that the purchasing power of the dollar is in a permanent, long-term decline. Your only defense is to convert your dollars into things that cannot be printed. Let's get specific. If you came to me today and said, "James, I have $10,000 to invest and I want to position myself closer to the source," what would I tell you? I wouldn't tell you to put it all in one place. I'd tell you to build a Cantillon-resistant allocation. 1. The core 60%, low-cost S&P 500 index fund. Why? Because the 500 largest companies in America have pricing power. They are the pipes. When money is created, a lot of it flows through these companies. They can raise prices, they can buy back stock, they can grow. 2. The hard asset hedge, 20%, a real estate investment trust, REIT ETF. This gives you exposure to commercial and residential real estate without having to buy a house. You own a slice of the buildings. You are a landlord, but without the phone calls about a broken toilet. 3. The commodity play, 10%, a commodities ETF or a gold ETF. Gold is the ultimate old money. It's the anti-Cantillon asset. It's been a store of value for 5,000 years. When people lose faith in the new money, they run to the old money. For the dry powder, 10%, this is your cash, but not in a checking account. Put it in a high-yield savings account or a money market fund. This is your opportunity fund. When the market corrects, and it will, you have cash that hasn't been devalued yet to buy the dip. You become the source for a moment. This isn't a guarantee. Nothing is. But it's a strategy. It's a way of thinking about your money that acknowledges the reality of how the system works, rather than pretending we live in a fair, meritocratic financial utopia. Look, I know this is heavy. It's easier to just check out and blame yourself. It's easier to think, I just need to work harder. But working harder won't save you if you're running on the wrong track. You can be the fastest runner in the world, but if the treadmill is speeding up every time you run, you're going nowhere. The Cantillon effect is the treadmill. It's the force that transfers wealth from the late movers to the early movers. Your job is not to complain about the treadmill. Your job is to step off it. Your job is to buy the treadmill company. Your job is to own the assets that benefit from the people running in place. Stop looking at your paycheck and wondering why it doesn't go as far. Look at the source. Look at where the money is created. And ask yourself, how do I get my little cup a little closer to that pipe? It starts with education. It starts with understanding. And it starts with taking action even if it's small. Buy the asset, take the fixed-rate loan, start the side hustle, move closer. The game is rigged, but the rules are public. Learn them and play a different game. Thanks for watching. If you want to dive deeper into these concepts and get the actual blueprint for building wealth in a rigged system, go check out the Frugal Investor ** newsletter. The link is in the description. Get your copy of the 15-day blueprint for wealth and financial autonomy. My name is James. Stop running on the treadmill, start owning it, and I'll see you in the next one.